A sense of relief has spread after the US and China agreed a 90-day truce on tariffs. If the 110 percentage point cut on additional tariffs on Chinese goods offers some reprieve, it might only be temporary. Also, temporary is certainly not a word that is music to the ears of the shipping industry. I'm joined today by Senior Vice President Specialist of the Ocean Freight Market, Tom Beney. Thank you for joining us, Tom.
Thanks for having me.
We might think that the drop in levies has opened a window of opportunities for transportation markets, but it's a lot more complicated than that, isn't it?
That's right. We've seen since the May 11th announcement and the reduction in tariffs, we've seen orders of containers from China to the US more than quadruple. We're talking about tens of thousands of containers, and that in turn has increased rates substantially. But what you have to understand here is that liner companies, which are controlling the container shipping market, have strings of vessels. And so, for example, you may have 5 ships in a string which go constantly from China to the US. And prior to the tariffs, they may have, and are more likely, have reduced their capacity prior to the 11th of May announcement. So that ship has been taken out of the string and put in another route. And for them to bring that route back on, they need to see consistent clarity, let's say, on demand that would come back for their services into the US.
And putting capacity back on this route will depend on an increase in orders from big retailers. But will they up their orders, do you think?
Well, that's a good question, and I think we have to go to the heart of consumer confidence in the United States, plus the state of inventory for the big retailers. So there's no doubt that we're seeing a massive increase in restocking that 90-day window is giving us. But consumer confidence in the US is down, and the latest news around Moody's downgrade of US government debt is not help confidence, inflationary worries, etc. So I would definitely look at the May, June, July retail sales numbers, and if they are steady to improved, I think you're going to see consistent demand for containers, and potentially then liner companies will put capacity back on that route from China to the US. But expect container rates for that route particularly to stay relatively strong.
So, what should we expect in terms of shipping rates in the short and medium terms?
Well, I would say that we've seen a massive spike. I mean, China to the US in April was for a 40-foot container was roughly around two and a half thousand dollars. That spiked to over 9,000 in the last week, and so we've seen a massive increase in rates, and I would expect those to go even further as people restock, whether it's producers in China getting their stock to the US prior to selling, or the big retailers pulling stock as quickly as they can to refill their warehouses. Um, and so that 90-day window is open. Uh, but what happens in the shipping markets is that you've got a percentage of the liner companies' fleets are time chartered in. That means that they're leased for a period of time. And what that does for the liner companies, it gives them the ability to optimize the routes. So they take ships out of routes which are underperforming and put them into routes which are overperforming. So we saw some of the China US fleets getting relocated during the downtime in March and April, to China into Europe, and now it's going to take time for that capacity to come back into the China US, and they've got to see the economics work as we've discussed. So I would say high, but we will spike and then come back to a normal, let's say, a relatively normal level for demand. But demand looks likely to continue for at least the next couple of months, and then watch the retail sales numbers as we've discussed.
And does the same apply to dry bulk, tanker and natural gas shipping markets?
Not really, because what we've got in those markets is China is the real major importer of raw materials, and that's what drives those markets particularly. So, if you think about industries like um, feeding people and feeding animals, production of steel, energy production, all those type of uh, primary industries. That's what drives the dry bulk tanker markets. And so we have four main things which are going on in China right now from a macro policy perspective, which is putting a lid on all of those things. So in the grains market, China is trying to reduce the percentage of soybeans in their animal feed, and that's a major imported product. Um, so that's putting a lid on the grain uh, shipments. When we look at coal production for energy, China consumes over 4 billion tons of coal a year. Now, what they're doing is that they're supporting their local coal production. And what that has is an impact on imported coal, and we see Indonesia as a major supplier to China is at 3-year lows in their coal exports into China. So then you have a real ramp up of renewable energy, wind, solar, and add on top of that nuclear and hydro, and those are starting to eat away at some of the um, coal and oil uses in China, and particularly as China's leading the world in electric vehicle production, um, and so there seems to be a lid on somewhat on gasoline consumption in China. And then I would say that the last thing is that China produces over 50% of the world's steel, and there is a policy now to start to reduce the capacity of that steel over the next months and years as it changes more from a manufacturing economy to more consumer and services type of economy.
Excellent. Well, thank you so much for your analysis and your insights, Tom. It's been a pleasure to have you on here again. We'll speak to you soon.
Thank you.
For more videos like this, please do like and subscribe.